Loren, in that first segment, we talked about some of the things people have in their investment drawer, and the 401k. I think a lot of people can kind of resonate with that. They have old 401ks at old employers. What should they do?
Yeah, the old 401k plan syndrome is what I call it, is very common, where you leave an employer, you don't know what to do with that 401k plan, and it is just simple. It is simple to leave that 401k plan there. You already have enough change in your life. You're moving, you're changing jobs, changing employers, and so you're worried about that. And then you leave that employer, and you have that 401k plan. So you're on the doorsteps of retirement, and you're thinking about all these other decisions you have to make as you make that transition from the working to the retirement years, and you're left with 2, 3, 4 old employer plans. Now's the time to get organized from an employer plan standpoint. There's a couple considerations that we need to have. One is if you have left an employer between the ages of 55 and 59 and a half, that means you can take distributions, you can take income from that employer plan and not have the 10% early withdrawal penalty. That's something that not a lot of people are aware of, because a lot of people are familiar with the 59 and a half rule, where if you take distributions out of your IRA or some 401k plans prior to 59 and a half, you have to pay an extra 10% on top of the ordinary income tax that you have to pay. But there is that one loophole where if you separate service after 55, if you're taking those distributions direct from that employer plan, you don't have the penalty. So if that is you, if you have that circumstance, if you're a part of that, then we need to be really careful on, do we move that money? Do you have enough liquidity if you were to retire or you needed some money prior to 59 and a half, or should we continue to leave it here? Those other employer plans that do not fall within that circumstance, then most of the time it does make sense for you to take that money out of the old employer plan and move it to your name, your control. That's an IRA. Now when you do that, if you do it right, you do not have to pay any taxes or penalties when you make that transition. Simply, you're taking the 401k and the old employer name off of it, and you're putting your name underneath the IRA on that money. And then you can consolidate all of those 401k plans into one simple account to manage.
Okay, the junk drawer is a little bit more organized already. Sean, one thing you see a lot of times is people have maybe several non-qualified accounts, and this is kind of a term you guys use in the industry. So first, let's make sure we understand what non-qualified accounts are, what several could look like, and maybe some tips to get those organized.
The non-qualified phrase does get confusing. Oftentimes, we're not sure what people are referring to when we talk about the non-qualified, but really when we talk about non-qualified, it's really just the opposite of qualified. When we say qualified, we're talking about money in 401ks, in the IRAs, in the plans that are acknowledged by the IRS. When we talk about non-qualified, that's where we're not getting any of the tax advantages of those accounts. So your checking accounts, your savings accounts, and then if you go beyond that, that next step that most people take is really to open a brokerage account. And that's probably most synonymous with non-qualified, is that you make sure you've got enough money to cover your month-to-month in your checking. You may want to make sure you have that emergency fund fulfilled with your savings. And if you're in a position where you have extra cash, we may want to go open that brokerage account. The challenges we see with the various non-qualified accounts is, what's the purpose? What are you doing with it? And then there can be a number of them. We hear oftentimes, your families are opening different checking accounts at different banks, different savings accounts at different banks. Maybe you're going to get those interest rate specials. So now you see the junk drawer that we're talking about with these different accounts at different banks. And sometimes, believe it or not, people do lose track of their money, and they may even forget about some of these accounts. Another aspect of the non-qualified is just the investment strategy. If you have brokerage accounts open, you're owning some certain investments. If you've got one over here, another one over here, those investment strategies may or may not be synced up and be doing the same thing, or at least you're not looking at those together. That can present some challenges, and maybe you're not being as efficient as you can be.
And sometimes, Loren, it's probably just a matter of kind of remembering. I mean, if you've been working for 40 years, you might have bought a term insurance policy that you kind of even forgot about. I mean, have you seen that happen in meetings?
One of the biggest questions that we get as people make this transition to the retirement years is they have this old term life insurance policy, or maybe even a group policy that you have through your employer, and you may have forgotten about it, or maybe it's just somewhere in the back of your mind as you're living life, going through all these other things that you go through. But now you have to make a decision. Do you want to carry this term policy going forward, or this group life insurance policy going forward? Do you still need life insurance? Those are the questions that we get that need to have answers applied to them, because term insurance policies or even group life policies, they cost you money. So as you're trying to put more definition around what your retirement budget or retirement spend looks like, all of these different types of expenses that you've always just kind of paid because you needed it at one point and you had this good W-2 income coming in, they become more important, and you need to become more intentional in the retirement years, where now you have a finite amount of resources that has to supply this income that you are going to need for the rest of your life. So an evaluation of, do you still need it? And if you still need it, what is now the new purpose behind this insurance product, as well as all of these other products that you've accumulated over the course of your accumulation lifetime.
Thank you for watching this clip of Retiring Today, and don't forget to subscribe. If you have questions about your retirement plan, take advantage of the complimentary 15-minute retirement checkup phone call.